Yo, let's talk. Why don't you have a million? Because you're watching me, but you don't have a million. Oh, okay. It's your mentor, Nyakallo.millions. I'm glad to have you back. Just like and subscribe. And yeah, enjoy the video. So, 80% of your losses can be prevented if you become more aware of your daily mistakes and the little things that hold you back. Just imagine how your account would look like if you make those small clicks and eliminate bad habits you have. Here's what I've done to reinvent myself as a trader. So when I first started trading, I tried to learn everything I could, bro. I tried to even read books. Imagine, trading books. I thought that was the key. With that being said, I was learning different strategies and techniques, bro. I thought I'd be profitable after 10 trades. I was just like you guys. But no matter what I read or no matter what I saw on YouTube, it never really clicked until later on. Then I realized that there's two different learnings, explicit and implicit. Explicit is reading about stuff in textbooks, while implicit is learning through actually doing it. Basically trading a real chart. Guys, trading is more of an implicit learning process than an explicit one. You can literally study patterns, indicators and theories all you want, but nothing teaches you like experience in live market. It's all about recognizing opportunities, guys. Trading books and trading videos like this one are mostly helpful for introduction just to new concepts and new knowledge, you know what I mean? But what really improves your trading skill is putting in the time, gents. Trading a real account, every trade imprints a lesson in your subconscious understanding without hands-on practice. The explicit stuff can only take you so far, you know what I mean? So with that being said, guys, being a consistent trader means knowing your own game. Ask yourself this type of questions. What type of market moves? Do you excel at reading? Are you better at trading breakouts? Do you perform better when the markets are quiet? Or when there's a lot of movement? Ask yourself that questions, guys. I had to learn this the hard way when I first started trading. I would force trades anytime price picked up or down, guys, regardless of what was happening. I wasn't paying attention to the previous price action during the day. So during choppy days with no clear indication, I would get stopped out every single time. More often than not, I would end the day in reds without realizing why. The key is being aware of what type of market conditions you perform well in and which ones are your favorite ones to trade. When the conditions are in your favor, that is when you have to be on your absolute A game. But if the price action is sketchy and you get the feeling that in your gut that you're gonna struggle, just walk away. Walk away. It is crucial to take some time to analyze what is really disturbing you. Is it choppy, low volume gaps, fake outs? Bro, talk to me. Fast price movement? Guys, this is half of the battle of learning to overcome this type of problems. Pay attention to different market conditions and only trade what you understand. So when I first started trading, I thought the way to do it was just to set my stop loss 30 pips below my entry on every single trade. Imagine. That way it would be simple, right? Be honest. Well, this strategy didn't work out so well. You know what I mean? After losing way more trades than I was winning, I realized that the market does not move in that way. It is not that predictable. During 1 hour, they jump around a lot in a short time. And the next one, they barely move at all. So setting those fixed losses didn't account for the natural volatility of the markets. That's when I started using averages, like, different indicators, you know what I mean? But right now, I use my favorite indicator called an RSI. It makes me see the market way better. Seeing that helped me understand why using a fixed number of pips wasn't a good approach. So these days when I talk about a trade, I first look at my RSI and also my ATR just to help me determine a dynamic stop loss rather than a fixed one. You know what I mean? I also pay attention to most moving averages, VWAP that acts like a support and a resist that gives me more flexibility to avoid unnecessary losses from the normal market fluctuations that occur from time to time. Another important topic is when to move your stop loss to break even. On the surface, it seems logic, but once you're no longer at the risk of losing, why wouldn't you lock that in, bro? In the past, I made a mistake all the time of adjusting my stop losses way too early before the market had really proven itself. All I was doing was taking the risk off the table, but I also kept my upside potential too soon. I'd get stopped out every trade, bruh. Almost every trade I'd hit a stop loss. Now I only try to move my stop loss here and there, you know what I mean? Once the market gives me a clear sign that my initial analysis was correct. For example, if the price tries to back to my entry point, but fails, that also tells me that my analysis was actually valid. Or if it makes a higher high or a lower low, confirming my trend. The key is to wait for the strategic levels. Psychologically, it feels good to be risk-free, but statistically, it affects your potential profits in long term. You know what I mean? So, I won't lie to y'all, something that is still a real struggle to me is holding on to winning trades. You hear a lot of cut your losses and let the winners ride off. It seems so simple, bro. It really seems so simple, but it's hard to fight that urge just to close a position very early. The feeling that you place a trade and things are going great, as a position goes into profit immediately, and then the market starts to turn around, you feel a bit nervous, bro. Be honest. Your hands are shaking, they are shaking, they just wanna press that close button. But I stop closing early trades, bro. Just wait. And most of the time, when you exit, it is because you're scared of giving back what you've earned, basically your profits that you've gained so far. But most of the time, if you took an objective look at the markets, nothing really changed. From a technical perspective, the move was still intact, but you settle for a small profit. And here comes the worst part. The market keeps going the same direction that you really expected it to go. You let your emotions get the best out of you. Now you've missed way more profits. And to be honest, it's a very common thing in trading. And really the valuable lesson about keeping a level head is still one of my biggest struggles, even after being profitable for a long time, bro. When I feel that panic is starting to settle in on a position, I ask myself a simple question. Is there actually a technical reason to exit, or I'm just scared? 9 times out of 10, I am just talking out of fear. Guess what? I stay inside because I'm that nigga, you know what I mean? Something that I've been really focusing on lately is understanding the correlations between different markets I might want to trade. Let me give you an example, Let's say there's a bullish pattern sitting on the pound dollar, basically GBP USD, and you want to take a long position. At the same time, pound yen GBP JPY is also showing a sign of strength. Since they both involved with the British pound, you might think twice. I'll double up by going long on both of them. Big mistake, because you don't know how close the pound pairs tend to move together. If the pound suddenly pulls back, it will trigger losses on both trades at the same time, bro. Your risk is doubled because of those two correlated positions. So be careful about your exposure before entering multiple trades. Analyze how the underlyings typically interact with each other. Are they usually in sync like the pound pairs, or do they have a history of divergence at times? Knowing the correlations will help you a lot. Avoid taking on too much risk in one direction. Leverage can be a real double-edged sword for traders, especially when you're starting out. Bro, I learned it the hard way. I definitely learned it the hard way. When I got access to leverage, I was super excited, bro. Because I really and truly thought that now that I have more money to place bigger trades and make bigger profits. The results, within a few weeks, I had already blown multiple accounts, especially the small ones. The problem was that while I was making the money on some trades, 1 or 2 losses totally wiped me out, totally. Because of my position sizes were pumped up by way too much leverage. A small move against me totally wiped out all my wins, bro. All my W's gone. It was a really expensive lesson that I learned. Using leverage safely takes experience. So please be careful, especially as a beginner, bro. Just don't be excited just because you see a bigger leverage. Don't be, bro. Keep using a smaller lot size until you can prove that you are a constantly profitable trader. Leverage will just come later. Once good risk habits are formed, you're gonna be very profitable. As I started taking trading very serious, I realized that having just a normal plan in my head was just not cutting it. You know what I mean? I was willing to bend a few rules here and there if I really wanted to take a trade. That's when I started writing a checklist of everything I look for before taking a trade or before entering a position. Before I take a trade, I go point by point. Like, is my chart set alright? How's the price action looking like? You know what I mean? Are the indicators that I want to use aligned with the supply and demand? You know what I mean? Stuff like that forced me just to slow down and really analyze objectively. I find it very valuable because it takes out the subjective emotions out. There's no room for irrational decisions. Either the trade hits all the boxes or it's a no-go. I don't trade at all. And having to write it out makes it very, very clear if I'm about to break my own rules or not. My checklist has done wonders for my discipline. Now I avoid so many trades because I know deep down they are not high probability trades based on my own strategy. Now, when it comes to setting profit targets, I see a lot of traders making the mistake of aiming very, very high without really thinking it through. Guys, I did the same thing. I would enter a trade and slip some ridiculous take profit. You know what I mean? Maybe 100 pips away. That was so impossible thinking like that. I thought the bigger the target, the better. Well, my results didn't think so. My win rate just decreased a lot. You need to have a realistic, achievable target based on the actual market structure. Things like nearby supply and demand levels that could reasonably stop a move, or using an ATR or another side to assist with taking partial profits. You know what I mean? The key is setting targets that balance with probability of success with adequate reward. I'd rather have 5 winning trades at 20 pips each than 1 out of 5 going for 100 pips. You know what I mean? It's not that sexy aiming for a few pips, but it's way more consistent in the long run. Consistency made me a big profitable trader. I don't just get big occasional wins, like, you know what I mean? Trading is 90% psychology, 10% technical. Understanding your emotions and psychological levels is very, very important in trading. We all have fears that can affect our success if left unchecked. We all have that inner trading demon. A big one for me was that fear of being wrong. You know what I mean? I had second guessing winning trades because I was worried that I might miss something, or I'd hold on to a loser trying to be right. Another struggle was that fear of missing out. I had FOMO, feeling like I have to jump in every move, whether my strategy is set or not. I also used to get out on winning trades very early because of why my psychology was not strong. Another issue I had was managing my ego. Recognizing your patterns very early is very key to find out what are your biases and what can actually do to diminish their influence on your own trading. And sometimes taking a break and just taking out the market is the best move. At the beginning of last year, no matter what I would put a trade on, I seemed to pick the wrong side of the trade every single time. And it was getting frustrating because watching my own profits decrease and my mind was not as sharp as usual. I started questioning every single decision and I was always second guessing my trades. I needed to step aside because as much as it pained me to leave the action, I knew that staying in this mental state was not good, and it would only lead me just to more rational decisions and more bad trades. So I just decided just to take a break, but I would only watch the chart, but I was not trading at all. No trading apps, no nothing, but I was still watching the price. It was not easy because I was missing the excitement and the rush of placing a new trade, but it was time to refocus. After that period, I was getting ready just to get back in the game, and with a cool head on, I came up with some minor adjustments to my strategies, like here and there. Taking breaks from trading is absolutely necessary, and I don't think I would have gotten this far if I didn't take a break. You know what I mean? Sometimes take a break, watch the charts, you live nice. Tango.